Alright, so ask and bid prices. When you go on a holiday overseas, you usually want to exchange your home currency for the domestic currency of the country you're traveling to. And in order to do that, you would go to a Forex exchange booth. And these booths will always have two different prices, a we sell price and a we buy price. And depending on the transaction you're trying to make, you will be quoted at one of the two prices. So if you're exchanging your home currency for the domestic currency of the country you're traveling to, you'll be quoted at one of these two prices. And when you come back and you have all this excess currency of that other country and you want to exchange it back into your home currency, you will be quoted at the other price. Same principle applies on the Forex market. Any Forex currency pair actually has two prices, the ask price and the bid price. The ask price will always be above the bid price, and the ask price is the price that you would be quoted at if you want to buy the base currency. If you want to sell the base currency, you will be using the bid price. So here we're using the British pound Australian dollar as an example, and in that currency pair, the British pound is the base currency, the Australian dollar is the quoted currency. So if you want to buy British pounds, then you will be using the ask price. And this means that for every 1 British pound, you would have to pay 1.8873 Australian dollars. Now, if you want to sell British pounds, then you would be using the bid price. And for every 1 British pound, you would get 1.8866 Australian dollars. So as you can see, you're always paying more to buy than you're getting when you're selling. And that's the principle of the Forex market. Spread. So as we discussed, the ask price is always above the bid price, and you will always pay more to buy 1 unit of base currency than you will get when you sell 1 unit of base currency. And that difference between the ask and the bid price is called the spread. So let's calculate the spread for this particular example for the British pound Australian dollar currency pair when the prices were as they're illustrated on this chart. So the spread is the ask minus the bid. That means 1.8873 minus 1.8866, and that means 0.0007. So that means less than 1 Australian cent. That is 0.07 of an Australian cent. And this is in Australian dollars because the currency pair is British pound Australian dollar, so Australian dollar is the quoted currency. Remember our examples with apples, so British pound here is like the apple, and Australian dollar is the currency that it's been valued in. So in this instance, the spread is 0.07 of an Australian cent, which is very low in our kind of understanding of the world, that when we go to an exchange booth, the spread is usually at least a couple of cents, maybe $1 or so on certain currency pairs. But on the Forex market, the spreads are very low, and this is called very tight spreads. And that's all right, because when you do very large transactions like banks do, or when you've got hundreds and thousands of participants participating that brokers have, they make up this money from the volume and the quantity of transactions. So simply put, the brokers actually earn this money, or the banks and the brokers, they kind of share this spread, and this is your cost of conducting a transaction on the Forex market. So if you ever want to participate and open a trade, you would always pay the spread, because you would buy at the ask price, for instance, and then when you close the order, you would close it at the bid price. So you inherently always pay the spread in any transaction, and that's your cost of participating in the market. And whether or not you make money, that's completely up to you, and that in a good broker, that has nothing to do with them. They make money off spreads and other things like commissions and swaps, which we'll talk about later. Pips and points. So this is going to be quite an important tutorial because a lot of people get these things confused, and I'd really like to help you get started in the Forex market knowing these things right away, so there's no question about it. So let's look at the 4-digit system to start with. In the 4-digit system, any currency pair has 4 digits after the decimal point. So except for Japanese-based currency pairs, where Japanese yen is the quoted currency, but we'll talk about that later. So the 4-digit system, 4 digits after the point, the decimal point, and the last digit is the minimum change. So the last digit is the 4th digit, and that means the minimum change that any currency pair can experience is 0.0001 units of the quoted currency. So the minimum change is always called 1 point. And this value on the right, 0.0001, is called 1 pip. And that's important to keep these things in your mind separately. The minimum change is 1 point, and 1 pip is 0.0001. So in this case, the minimum change is equal to 0.0001, and that means 1 point is exactly equal to 1 pip. And that's going to be the case for every single currency pair if it is quoted in the 4-digit quoting system. So let's go back to our example of the spread. We calculate the spread as ask minus bid for the Australian dollar, and it was 0.0007 Australian dollars. So let's express this now in points and pips. This is equal to 7 points because it's 7 times the minimum change this currency pair can experience, and it's also equal to 7 pips because this is equal to 7 times 0.0001. 5-digit quotations. So now we've got a new system in the Forex market. It's been around for a couple of years now. The precision of price quotations is getting better, and now most brokers actually supply quotations in a 5-digit mode. So here, that quotation we were talking about for Australian British pound Australian dollar, 1.8866, now is actually more precise, and it's 1.88663. So now the minimum change this currency pair can experience is actually 0.0001. So 10 to the power of -5. Now let's understand how the definitions of pips and points have changed in this particular case when the 5 digits system has been introduced. So the minimum change is still called 1 point. Minimum change is always called 1 point. Now the value on the right, 0.00001, has been labeled with the name pipette. Once again, let's keep these things separate. 1 point is the minimum change, and 1 pipette is always equal to 0.00001. In this case, it just so happens that the minimum change is equal to 0.00001, and that means 1 point is equal to 1 pipette, and that's always the case for 5-digit price quotations. So once again, let's calculate the spread. Here I've shown our previous example, but I've added the 5th digit as a smaller number, and a lot of brokers do that just to show that it is 5-digit quotations, because when you have 5 digits after the decimal point, it can be it can get a bit confusing and like a lot of numbers. So here it highlights to you that these are in fact pipettes on the end of the currency quotations. So the difference of the ask and bid price in this case is 0.00065 units of the quoted currency, which is Australian dollar, and that equals to 65 points. So let's remember that even in the 5-digit quotation system, a point is the minimum change that the currency pair can experience. In this case, the minimum change is 0.00001, and if you multiply that by 65, then you will get your spread. So the spread is 65 points. On the other hand, the spread is approximately 7 pips. You can say 6.5 pips, You can say 7 pips, doesn't really matter. It's approximately 7 pips because a pip is still 0.0001, just as it was in the 4-digit system. It's not going to change because we changed the system that we're quoting the currency in. A pip is fixed, a pipette is fixed. So this spread is approximately 7 pips, and that is, you can also say that this spread is 65 pipettes. I would advise you not to use the word pipettes because not many people understand you. Like I never use it. Nobody ever uses it. It's a very kind of new term or very, very low use term, and just sounds funny to be honest. So just stick with points and pips. So just to sum up, we've got the 4-digit system, the 5-digit system. An example is the British pound, Australian dollar. Quotation that we looked at, 1.8866 in the 4 digits, 1.88663 in the 5 digits, 1 point in the 4 digit. 1 point is always the minimum change. In the 4 digits system, it's 0.0001. In the 5 digit system, it's 0.00001. A pip never changes. A pip is always fixed regardless of the quotation system, and it equals to 0.0001. And a pipette, there's no such a thing in the 4-digit system. In the 5-digit system, because there's enough precision, you can talk about pipettes, and it's 0.00001. However, I do advise not to use this term because it's not frequently used. So you will notice that some traders out there get this mixed up, and actually some respectable traders can get this mixed up because this is terminology, and it of course depends on the conventions and like the people, well, how people agree to talk to each other and use these things. But most traders will use this system. So if you come across a forum where perhaps even everybody uses them wrong and confuses pip and point or something like that, well, then you either have to re-educate those people or adjust to their kind of style. But just keep in mind that majority of traders around the world will talk about these things in exactly this way. And before we finish up, a quick note on Japanese currency pairs as promised. So if a currency pair is quoted in Japanese yen, meaning that the Japanese yen is on the right, you will see that everything is shifted by approximately or exactly 100. So there's not, in the 4-digit system, there's not 4 digits but 2 digits after the decimal point. In the 5 digits, there's only 3 digits. So everything else stays exactly the same, just multiply everything by 100. And that's just been associated with the way the Japanese yen has historically been priced. For instance, right now, $1 American can buy you 118. Alright, so lots. A lot is a measure of volume of a transaction on the Forex market. One lot equals to 100,000 units of base currency. 0.1 lot equals to 10,000 units of base currency. 0.01 lot equals to 1,000 units of base currency. Also, 0.1 lot is called the mini lot, and 0.01 lot is called the micro lot. So let's have a look at an example. For instance, you want to trade the EURUSD and you want to conduct a buy transaction with the volume of 1 lot. That means that you will be buying 100,000 euros in that one transaction. The ask price with your broker is currently 1.23228, and that means that in order to buy 1 lot of EUR/USD, you need 123,228 American dollars on your account. So obviously this number is astronomical, and when we come to trade the Forex market, we don't have such money. How can we still trade the Forex market? Well, we'll find out about that when we talk about leverage. So, leverage. As we discussed, in order to buy or sell 1 lot of EUR/USD, you need 123,228 American dollars on your account, which is a lot of money. But even in order to trade with 0.1 lots, you need 12,000 American dollars. And in order to conduct the smallest transaction possible, a micro lot, 0.01 lots, you still need $1,200 on your account, which is a lot of money. And what happens if we can't afford to have an account of that size, or we're just not ready yet? We're practicing and we don't want to invest that much money into the Forex market. How do we trade then? Well, this is where leverage comes into play. The concept of leverage has a lot of negative sentiment around it, and people kind of think that it's bad for you or dangerous, which is completely not true. And in this and the next tutorial, we will disprove those fears. So what happens with leverage is your broker will actually lend you money in order to help you conduct transactions on the Forex market. So in this picture, your money is on the right and the money the broker lends you is on the left. So let's have a look at a particular example. For instance, your balance is $500. And you want to conduct a transaction with the volume of 0.1 lots on the euro-dollar currency pair. So you require 12,322 American dollars to conduct this transaction. Obviously, your balance is insufficient at this stage. But with leverage, if your leverage is 1 to 100, then your broker will actually only require you to have 1% of that money, and the broker will lend you 99% of the required amount. So in this case, your broker will lend you $12,199. So you're borrowing 99% of this required amount. All you have to invest is $123 of your own money. So that is 1% of the transaction, and that is much more affordable with your balance of $500. And in this case, you can now conduct this transaction and participate in the Forex market, either buying or selling the euro-dollar. So that's how leverage works. But why would the broker do this? Why would the broker lend you money? Well, to find that out, we have to talk about equity and margin, and we'll do that in the next tutorial. Equity and margin. In the previous tutorial, we explored an example where we were opening a hypothetical order of 0.1 lots. Now, to create this transaction, we required $12,322. And because that was quite a substantial amount, we explored the concept of leverage. And in fact, we found that with a leverage of 1 to 100, we could borrow 99% of the required amount from the broker, and we would only be required to put in 1% or $123. Now that amount that we need to put in, the $123, is called the margin for this transaction. And today we're going to talk more about the margin and find out exactly why the broker is willing to lend us 99% and how leverage works in the background and how all of these concepts play out when you open an order and when the market goes against you and when the market goes in your favor. So let's jump straight into it. So here is our $500 balance, and now we want to open that transaction which we talked about. So the broker puts in $12,199, we put in $123, the $123 is our margin, and the remaining funds, so the 500 minus the 123, the $377, that is called the free margin. Now here we're going to introduce one more concept, and that is the concept of equity. Now normally equity is defined as the balance on your account plus or minus any unrealized profit or loss. So basically your balance is constant until you actually close your transaction, but your equity reflects whether the market is going in your favor or it's going against you. However, in this example, to start off with, we're going to kind of introduce equity backwards. We're going to introduce equity as the free margin on your account plus the margin. There's no big difference, and you'll see just in a few moments how that is exactly the same as what we discussed about balance and unrealized profit or loss. So there's our equity. We're going to outline it with a green bracket here on the right. And now let's see what happens as the market moves in either direction. So we'll start off by looking at what happens when the market moves against us. So if the market moves against our position, then first of all, let's say it moved against us and the unrealized loss on our account is $100. So as you can see, the margin is intact, the broker funds are intact, but the free margin has reduced by $100. And therefore, our equity has also reduced by $100. At the same time, we should note that the balance hasn't changed. So that big box the overall box is still $500, and still it looks like we have $500 on our account because that's our balance, but in reality there is an unrealized loss, and it's called an unrealized loss because you haven't yet closed the transaction. So that loss might change into a profit with time, or it might increase as a loss. So if the market keeps going against us, now the free margin has reduced by $200 and the equity has reduced by $200. And at the same time, the borrowed funds and the margin, the frozen margin, are still intact. Now, what happens if the market keeps going against us? Well, what will happen is a stop out. So a stop out is when the broker sees that you have lost quite a lot of funds and you don't have any free margin left, and in that case the broker will automatically close your position, and this loss will become a realized loss, and that way they will be able to pull out of this position. So because they lent you some money, now they see that the position has gone against you, they don't want to lose any of the money that they lent you, so they're just going to close your position and pull out their $12,199. And in this case, the margin acts as a safety net or a safety buffer. So basically the broker is saying, okay, this trader doesn't have any free margin left, we should close the position, and in that case, what will happen is they pull back their $12,199 and you get back your margin. So your margin is returned to you. So why does the broker use this margin as a safety buffer? Well, because while they're closing the transaction, the market can actually move and they might not have enough time to close the transaction spot on that margin level. So the market might even move a bit further against you and might eat into your margin, and you won't get $123, you might get $100 back or $90 back or even $50 back. So that is their safety buffer. So that is the funds that will get eaten into before the funds that they actually lent you. So that's how the broker uses the margin as a safety net. And as you can see, the equity has also reduced to the size of the margin. Now, the stop out can happen at when all of your free margin is eaten up, so when you only have margin left, or maybe when you have half of your margin left. So the broker might, in its terms and conditions, specify that it will allow 50% of the margin to be used up before the stop out occurs, or it might allow 70% of the margin to be used up. So you have to refer to the terms and conditions of your broker to understand at which point a stop out will occur. And another thing you should be aware of is that sometimes there'll also be a margin call. So a margin call normally occurs before a stop out, and it's a warning from the broker telling you that you're getting very close to the stop out level and you should intervene and do something about it. Now, it's not necessarily going to happen. You're not necessarily going to have a margin call, and in fact, a lot of brokers might have the margin call set at the same level as the stop out. So basically the margin call won't happen because it's too late anyway, the stop out has occurred. So that's another thing you should look into and check with your broker, check in the terms and conditions or the product disclosure statement and find out is there a margin call, when does it occur, what levels do the stop outs occur at. Okay, so that's what happens if the position goes against you. Now let's see what happens if the position goes in your favor. Back to the start, here we've got our equity on the right, free margin and margin, and let's say you have set a take profit somewhere up at the top over there where the dashed or the dotted line is. Now, if the position moves in your favor, so here we can see that we've earned some money. As you can see, your position still isn't closed, so your balance is still $500, but your free margin has increased. So any unrealized profit or loss is being added to your free margin, and therefore, as you can see, your equity is increasing. And that's a good thing because now you can use this free margin to open more transactions if you wish to do so. But we're not going to go into that. Let's continue with this example. So your free margin is increasing, your equity is increasing, and the market keeps moving in your favor, and it hits your take profit. Hooray! Your free margin has increased, your equity has increased. At the same time, you can see that the margin is still the same, still $123, and the amount of money that you borrowed from the broker hasn't changed. It's still $12,199. So what happens next is your position closes. The broker pulls back their amount, so they take back their $12,199, and your margin is released and it is added to your back to your account. So it was always on your account, but now it's released and it's no longer a frozen margin. So now your balance is $773. So as you can see here, that is one of the great advantages of leverage, is that the broker just at the end, when the transaction is complete, all the broker wants back is the money it lent you. They don't want, they're not going to penalize you for using leverage, and therefore you get to keep all of the profits you made. So even though you borrowed money to open this transaction, you get to keep all the profits you make. The downside, of course, is that any losses you make are also you're going to be liable for any of those losses that you make. So there we go. That's how leverage works. And in a way, it's kind of like a magnifying glass. Without leverage, you can only conduct, if you even have enough balance to conduct the smallest amount transactions on, like micro transactions on the Forex. With leverage, everything is magnified. So you can conduct greater transactions, you incur greater profits, and at the same time you will incur greater losses if they occur, and you only have that amount of money that is on your account to accommodate those losses. So as soon as your money runs out, as soon as your free margin runs out, the broker will pull their funds back. So in a way, I like to think of leverage as a sports car. So of course you can hurt yourself by driving a sports car, but if you know what you're doing and if you're careful about it and you're just driving it safely, then you can derive substantial benefits from it. And same thing with leverage. Of course, you can hurt yourself and there are substantial risks associated with leverage. But on the other hand, if you know what you're doing, if you calculate your risks, and if you're careful about it, then you can derive substantial benefits from having that leverage. All right, so that's how leverage works. And before we conclude this tutorial, I would like to highlight one more important key risk associated with leverage. So I'm going to go back to our example here, and let's go back to the example where the market goes against us. So here you can see that there's a stop out, which kind of is a safety net for the broker, and after the stop out happens, you get your margin back, the broker gets the amount that it lent you back, and that's the end of it. However, sometimes it so happens on the Forex market that the movement that caused your position to go against you, that can be so quick and so volatile, so like it can be such a big movement that the broker might not have enough time or might not have an opportunity, there might not be a price in the market for your position to be closed at the stop out. So the broker is intending to close it, but it's just not able to do it. So in that case, as we discussed, your margin will start to suffer, and the funds will be, any additional losses will be taken out of your margin. And that way, your margin is like this little safety buffer between your funds, your free margin, and the broker's funds, the ones that they lent you. But at the same time, if that market movement is so drastic and so quick that it actually chews up through all of your margin, then what will happen is that before the broker is able to close the position, the broker's funds will start to suffer. So the market will start eating into the 12,199 that the broker lent you in this specific example. So, and that is an additional risk. So if the market moves so quickly that it eats up all of your margin and it uses up some or even all of the money that the broker lent you, then you should be aware that you will be liable for those funds that were used up from the amounts that the broker lent you. So you need to check the terms and conditions, but there's a very high chance that you will be liable for those funds, and the broker can reclaim them back from you. So the broker can ask you to pay back that money. So be careful with that. That is an inherent risk of using leverage. And of course, this risk is has to be verified with your broker, has to be checked with your terms and conditions, but you should make yourself aware of that, and you should understand this risk when you are using leverage. So I just wanted to make sure that you're aware of that. And that brings us to the end of today's tutorial. There we go, talked about equity and margin, and hopefully now you have a very clear understanding of how leverage works and why exactly brokers are willing to lend you that money. Okay, I look forward to seeing you on the next tutorial, and until then, happy trading.